This is Phil Tiley from Alters Group. This is a re-recording of our webinar that we hosted last week on the 4th of August. So the webinar is where we analysed the latest results in the NCREIF ODCE index due to a technical hitch. Unfortunately, that recording didn't quite make it to market. So just re-recording a narrative today of the slides, so that everybody can get access to that. So just to repeat some top line pointers that I mentioned the other week is here we're analysing all 26 ODCE funds. So that's one less from last quarter, one fund dropping away from the ODCE index sample in the last 3 months. Within Alters, we have a data set, a valuation data set, 175 portfolios, and we then match them up with the ODCE funds to provide added intel into the analysis, utilizing the full range of the valuation metrics. The webinar is kind of part there for an insight to our wider advisory network to get an understanding of the dynamics of the market, but also part as a precursor to the one-off client conversations that we are now going to be holding over the weeks ahead when we view individual portfolios from a comparative performance standpoint, drawing on that valuation data. So I'm Phil Tiley. I head up the performance and analytics side of Alters. My colleague who was with me on the day is Robbie Tanjeng. So unfortunately, just in the interest of time to get it recorded, that it's just me taking you through the numbers. So I'm going to flick over now and share my screen, and then we can go through the slides that we presented on the day. So opening up those slides there onto full screen. So we're very grateful for everyone dialing in to this webinar. So thank you for your interest in our service, and obviously I mentioned up front a big thanks to everybody that gets involved in this data exercise, both on our side in terms of within Alters, the performance team, Mike Amthor, Eddie Hall, and then the wider advisory business unit that process all the valuation data, and then see all the clients that provide us with privileged access to their data. So we did ask some polling questions. So I've got the results for those. So I thought it'd be useful still to share those. So the first polling question is just to get a sense of the demographic of our audience. So and which showed that 80% were NCREIF data contributors, but there's obviously 7% NA because they may be service providers, but there's 13% out there that are running portfolios that aren't providing data to NCREIF. So my reaction to that is kind of strongly advise people to kind of engage with NCREIF, because if the data on the portfolios just gets passed through to NCREIF and those organizations are already clients of Alters, then we can provide this full service around the analytics from a comparative performance standpoint. So, and if that's of interest, please get in contact with your Alters advisory client lead or myself, Phil Tiley at Alters Group. So let's get into the numbers again. So these are the headline returns that we are analysing for the purpose of the presentation. Just to qualify, this focuses on pure real estate performance. So we're not incorporating the overall fund level return here. So there's no leverage in this. There's no cash. It's net of fees. So we're looking at how pure real estate performance levels have been playing out. So starting here with the headline numbers, which are income and appreciation, the overall return for Q2 came out at 3.7%. That's quite a step down from prior quarters, which you can see here have been in around the 6% range, up to 6.8% at the back end of last year. Developments, which you can identify from the variant between the overall and the stabilized return. So they're still providing some premium performance levels, adding 10 basis points to the overall return. So possible indicator of the ongoing strength of the market there. We then color-coded the sectors up in relation to that 3.6% stabilized overall return. And you can see the first point to note is that returns have really come down across the board in Q2, but there's still a fairly familiar look to the overall rank order in terms of performance. So industrials are still very much leading the pack out there in green, the front runners, but the return there has seen the largest cutback from 11.5 to 6%. Multifamily or apartments, which have been very much in growth mode, are also losing some of their momentum. So returns there down from 5.6 to 4.3. Other, the largest part of that at the base there is self-storage. Returns here are also being scaled back by more than 2 percentage points. So they're now more aligned with the multifamily sector at 4.3%. And all three of those are in green. They're still, all three of those are in excess of the ODCE overall average. You contrast those sectors then with the retails and offices, which continue to trend below averages. Retail's 1.7% return is a little bit more muted than it was in the prior 3 months, but still ahead of where it has been, and still seeing some positive appreciation within that 1.7% return. Offices, on the other hand, there have rooted to the bottom end of the order and have experienced more of a setback, so a return of 0.6% there, appreciation turning negative within that number. Put another slide in there just on the overall returns, just to look at performance on a 1, 2, and a 3-year basis. If you go back 2 years, you don't quite capture the full extent of the pandemic, with the larger write-downs occurring effectively in Q2 2020. So we thought this time round we'd extend the series back and look at things also on a 3-year window. But whether it's 1, 2, or 3 years, what stands out is that industrials have pretty much been streets ahead of everything else. So they've opened up a 10 percentage point lead on a 3-year time frame ahead of their closest rival, which is another other grouping where the predominant part is self-storage, an even larger gap opening up over 2 years, and the performance has been particularly rampant when you look at the performance over the last 1 year. Other categories also typically being a stronger performer there in green, and apartments or multifamily are also just a shade ahead of the overall ODCE on a 3-year basis. 10.9 plays 10.8, and a lot of that lead has been developed out over the course of the last 12 months. So they've all got double-digit rates of return. Contrast that with a more muted performance of the retail and the office sectors. Retail seeing more of the earlier setbacks with those negative rates of return at the start of that annual time series, but they've since moved ahead of the office sector and are starting to see growth returning to the retail sector. So a real changing of the guard at the lower end of the order, but lots of variations in those numbers, which I will hopefully take you through over the course of the next 40 odd minutes. So let's move back to the top level overall numbers. This chart breaks the returns down into their income and appreciation components and helps put the current performance number there into an historical trend, and illustrating the extent to which the market may now be past its peak, so to speak. So a 3.7% return, still a comparatively strong number, but a notable step down from those exceptional returns that were achieved in the prior 3 quarters. But you can see there's still a lot of upside in that latest Q2 return, especially when you're looking at the size of that red bar, the appreciation piece, when you compare that to the period of returns running up to the start of the pandemic, and even compared with that growth spurt between 2013 to 2016. So despite a slowdown, real estate really does continue to strengthen. And that period of write-downs at the start of the pandemic in 2020 has now very much been overshadowed by what has been now 7 successive quarters of valuation growth. But the pace of growth has slowed. Where it gets interesting is when you look at the makeup of that appreciation return, which we're able to unravel at ODCE using our market-leading valuation data set. So breaking the movement in values down into what might be termed the pure economic fundamental aspect of appreciation versus what might be termed the investor sentiment. So here on the next slide, we're transposing the red bars here into the red line and bifurcating that red line into what's termed the yield versus the cash flow effect. So the yield effect here first. Here we're measuring the impact of what might be termed the pure pricing levels on value. So that's the change in the discount rates and the exit caps. That's, I guess, the investor sentiment or the capital market side of the equation. For the blue bars, we're identifying the impact on value from the change in those forward projected cash flow trajectories. So that's more the occupier versus a demand versus supply side, the fundamental side of the equation. The big news in the wider economy clearly has been the moves by the Federal Reserve, increasing interest rates to combat rampant levels of inflation. And in the last quarter, we've seen this filter through into real estate with those yields now edging back out again. And you can see from that yellow bar below the line, having a negative impact on appreciation. There's not a direct relationship clearly between the movements in the 10-year treasuries and real estate yields. Otherwise, we'd have seen the yields move out back in Q1. But it's more how those rate rises are being perceived, which is part of a wider narrative, but also how that increased cost of capital is inevitably leading to some reset of pricing levels. And this offset was still pretty minimal within the wider scheme of things, but it is reversing a trend that has been in evidence there if you go back to 2013. So that it's actually only been two quarterly periods where yields have actually risen other than the latest quarter. So one was back in 2019, and that's largely associated with the write down of malls within the retail sector. And then again, yields rose at the immediate onset of the pandemic. The latest increase, though, is driven by a different set of circumstances. Those rate rises by the Fed starting to play on investor perception of the market as a whole. And I guess concerns that rate rises by the Fed may tip the country into recession. Add to that the fact in recent reports we're seeing falling in consumer confidence. We're seeing slowing the housing market in the US. Jobless claims are on the rise. And the fact the economy has seen two successive quarters of contraction in terms of falling GDP levels. But we're not seeing those economic concerns at a headline level in these Q2 numbers. From a cash flow standpoint, those actual cash flows for real estate, the blue bars, have in fact continued to improve, and that cash flow metric has actually stepped up in order of magnitude in the latest quarter. So the reversal in pricing is really what has tempered the appreciation levels in the last quarter. But that's an overall story. The next slide investigates how that narrative is broken down across the individual sectors. So first, you want to be focusing here on the right-hand side of these bars. Shorten the time series from the prior slide so you can get a kind of zero in on the period of the pandemic. We've also put some historical kind of numbers in there to give you some context as well. So if you focus just on the blue bars, first of all, those improving cash flow levels that we saw in the prior slide here are really being traced through to the apartment, the multifamily sector, where that cash flow metric stepped up in order of magnitude. So the fundamentals here are picking up more so than they did in the opening 3 months of the year. The industrials look to be possibly past their peak in that regard. I mean, cash flows are still adding, 8% to appreciation. So that's still a comparatively large uplift within the wider real estate arena, but it is a reduction from the prior couple of quarters. So maybe the industrials are past their peak in that respect. Offices, meanwhile, continue to pretty much flatline, a small slither of positive there in terms of cash flows, but those values are net down in terms of an appreciation return standpoint. And the retail's also pretty muted, but cash flows are moving in the right direction. So there's clearly some divergence there across the sectors from a cash flow standpoint. You then focus on the yield effect side, the yellow bars. The first point to make is that yields did move out in each of the four main sectors, but we've seen more of a correction in the stronger two sectors up top, where those underwriting kind of levels have become quite aggressive in recent quarters, and where the spreads are clearly a little bit more apparent. Yield increases for the more subdued office and the retail sectors, while maybe not as impactful from an appreciation standpoint, may though be pricing in, I guess, more strategic risk associated with those sectors, especially when it comes to the office market, a sector continually shrouded with uncertainty. So there's kind of different psyche there being played out at the two ends of the market in terms of pricing. On the one hand, taking away some of the heat from the office and the industrial sectors, and then on the other hand, pricing in a little bit more strategic concern maybe into the office and the retail markets. Substituted on the next slide, the industrials in the top right there for other. So similar topography between the industrials and the other, just not hitting the same heights. I've actually rescaled this next slide here, so you can actually now see some of those movements in the office and the retail sector a little clearly, especially that tick up in cash flow there for the retail sector. But other was the one sector where we didn't see yields move out in the last quarter, so maybe just worth noting that point. Taking a deeper dive into the appreciation breakdown. So here we are ranking the sectors in terms of the levels of appreciation, decoupling the yield from the cash flow effect. So this is just the metrics for Q2. And you can see quite clearly how the appreciation levels in terms of the rank order is really played out by those blue bars from the cash flow side. The impact on pricing is pretty minimal within the wider scheme of things. And you do have that inverse relationship here when you relate that to the rank order of the sectors. But we can pick both apart. So let's start with the yield effect first. This is how much rates in terms of the discount rates and the exit caps have moved in the last quarter. As you would expect, they're seeing more movement on discount rate, I guess, given the intrinsic link there with the cost of capital, but I guess no surprise to see those exit caps also widening. Industrials there at the top saw the largest correction, so that's almost a 15 basis point increase to discount rates. Apartments actually similar discount rate improvements to retails, and actually not as much in terms of movement out of offices, but those apartment movements are coming off a lower base, and so that's what's had a bigger impact on value when you're looking at that yield effect on the left-hand side. Turning to the cash flow effect. Now we relay that kind of cash flow effect impact on value to a series of 6 key metrics. Now this isn't an exhaustive list, but no, they're the key ones that we typically pull out. There's no perfect science to this, so you can't sum up those bars on those 6 metrics to the right-hand side to get those cash flow effects. But the green and red give you a sense of what's having a positive or negative impact on those forward projected cash flows, which then in turn impact on value change. So on the downside, we have seen some, but not a significant amount of vacancies coming through in the last quarter, the exceptions of the retails, where hopefully is now past the worst of it, and the others which continue to strengthen in terms of occupancy levels. The key variant, though, when you're trying to explain the cash flow metric, really comes through in those kind of face market rent movements. Industrials have been the main beneficiary up there in that regard, followed by apartments and other. You contrast that with office and retails, which have remained pretty much static in that regard. Similar order when it comes to the changes in those kind of actual contract rents. Then moving across to the right, you've got those projected growth rates, which actually on the next slide I've opened up into a 1, 2, and a 3-year basis. So here it's the multifamily sector, the apartments that have seen the largest positive adjustments in the last quarter. So this is the movement in those 10-year growth rates and how much they've moved in the last quarter. But I've also kind of labeled out the movement in the 1, 2, and the 3 years. But it's the multifamily sector that's seen the largest strengthening in that regard, and that's really what's helped push their cash flow levels ahead of where they were in Q1. Growth rates for retails and offices also down the bottom there are stepping up over the prior quarter. I put in there, as I say, the numbers as well as how much those rates have changed in year 1, year 2, and year 3 over the course. So you can get a sense from the numbers of what growth rates are actually being priced into the values, and those year 1 rates for retail and offices 2.1, 2.3, just to note, are still sub kind of pre-pandemic levels. Growth rates through industrials, just worth noting up the top here, are down a fraction. So starting to possibly see some of the heightened expectation there being reined in a fraction. But that's really counterbalanced though by what is that, about a 7% increase in market rents. If you move across to that year one operating expense ratio, just to explain this one here again, we're measuring the change here in the projected operating expense as a percentage of the gross anticipated rent over the next year. So it's kind of cost to revenue carry and how much that's moved out over the quarter. That's been trending back down for a number of sectors, so having a positive impact on value. Offices, though, it's still continuing to move out. And that's part cost escalation, but it's also part ongoing rental concessions. And offices are also seeing the larger increase there on that final column there of an increase in capital costs that are being modelled. That, I assume, is linked to the general realisation of the need to invest more, I guess, into the office sector to ensure it remains competitive in the wider real estate landscape. So, in summary, across the sectors, offices seeing no real movements in rents, and then an increase in the outgoings and in terms of the concessions, but also an increase in the outgoings, that then putting a further downward pressure on values. Retail's a little bit more upside than their office counterparts when you look across those key valuation metrics. And then what's really underpinned the growth of the industrial, the apartment, and the other sector are those positive movements in market rents, and for the apartments, that uptick in growth rates. If you cast the results back over 3 years, just to see how the market has played out through the period of the pandemic, on the left-hand side, you can see the appreciation levels are still net down from where they were 3 years ago for retails. Offices only just. Remember, this goes back to kind of Q2 2019. So there's a couple of quarters pre-pandemic in there. And office values back then were still ticking upwards, whereas retails were, I guess, already in decline. Industrials very much the front runner. Appreciation for other and apartments also running above average. And most of the variant, when you're looking at the appreciation, is being played out on those blue bars, that the cash flow side of the equation. But also, you can see some positive pricing uplift being achieved by those better than average performing sectors. Contrast that with retails, where the offset is both yield and cash flow related. Just opening up the cash flow variant on a 3-year basis. Let's focus on, first of all, down the bottom, what's held back the offices and the retails. So first of all, reduction, and this is over a 3-year period, reduction in occupancy level. Second, seeing no real movement in those kind of market-based market rental levels over a 3-year period. Contrast that with the growth levels up top. Add to that those kind of 10-year growth rates for the office sector have come down from where they were 3 years ago. I mean, retail's a shade up, but they were already being scaled back pre-pandemic, and you can actually see that most of the offset is in that year one, where both offices and retails are sub where they were 3 years ago. Then you have the kind of rental concessions and rising costs hitting the office sector the hardest, and then add to that both retails and offices seeing an increase in those capital costs. And up top, I mean, industrials leading very much to the front there, and leading very much in terms of improvements in market rents and in terms of the upscaling of their growth rates, which you can then see also down the bottom in terms of the movements over the 3 years in the 1, 2, and 3, and those levels to which those growth rates are currently on average being set. Okay, let's go back to returns and return to the latest quarter. So here we're seeing how those returns are shaking out across the major metropolitan markets, which we've ordered here from west to east. This is the one breakdown that we apply when we analyze the portfolios that work with us on a comparative analysis basis to look at their attribution, how well they're positioned into these markets, and how they're performing across those in terms of allocation versus property-specific variances in return. but just in terms of the headline numbers that we're showing here, and just to explain, I wanted to use this just kind of to explain the format really here and pick up on some top level variances, and then we'll go into each sector in turn. So just to explain the color coding up the top here. So everything is in relation to that 3.6% overall operating asset return. And so for the first time, it's not greens, all greens across the board when it comes to the industrial sector. So you've got that Houston and Chicago 1.6, 3.2 coming in, sub that 3.6% rate of return. For apartments, the top line there, the main talking point separating mainly from the greens from the red squares has been that divide that's been opening up between the Sun Belts and the gateway markets. Stronger return in Boston being picked up in the last quarter. We'll definitely go into that. For offices, then in retails, though, we're predominantly seeing reds across the board. It's all reds for offices. I think just one green there for retails in terms of that retail sector for Boston there, which is kind of consistent with the strength of the multifamily return there. But generally binary in that it's kind of more predominantly reds for offices and retails, and then for greens for other more greens and reds on the board, as you might expect, with that predominant part being self-storage. So that's all relative to the 3.6. Let's shake up the color coding on the next slide. So now we're showing the same numbers, but the color coding highlights the variances north or south of their respective sector averages. So if you focus on Dallas Industrials there, in the prior slide, 4.4% return is accretive to the overall ODCE as a whole, but 4.4% is running below the 6% average for industrials. On the lowest chart here, just to explain what we're showing here, this is just the return variance between Q2 and Q1. So most of those returns have been scaled back. Most of those kind of squares are in red, culminating in that 2.1% lower rate of return in Q2 than we saw in Q1. I've also repeated the kind of return variances here and the color coding north or south of their respective averages for a 1-year top chart and a 3-year basis, but want to go through the kind of current quarter, but also some 3-year analysis as we go through things sector by sector. So that's really there as a takeaway for people to review at their leisure. So let's start with the apartment sector and just pick up some major variances there that we're seeing in the latest quarter. So the main talking point for apartments has been that power shift between the gateways and the improving Sunbelt markets. At the lower end of the order, seeing those red squares up top, you have San Francisco, 2.8, very little separating that from Chicago, 2.9, and 2.8 for New York. So kind of hair's breadth between those bottom end performing kind of more gateway markets. We did see Boston move up the rankings this last quarter, 5.8% rate of return there, but it's that archetypal Sunbelt market, Miami, that's leading the way with an exceptional 7.8% return within the context of the multifamily sector. Look, there is a bit of movement there in terms of what have been some of the stronger markets. So the likes there of Denver and Atlanta, which have been proving their attraction since the onset of COVID, did drop off the pace in the last quarter. So they're 4% and also 3.2. So maybe not such a clear-cut divide this time round between the gateway markets and the rest. So to get a better sense of what's disrupted that hierarchy, let's look into the variances in the appreciation return. So rank order in terms of the appreciation return on the left-hand side, then unpacking that into those pricing versus cash flow effects. And when you're thinking of Atlanta and Denver, what's really held things back there from a performance standpoint, I guess, are the larger yield increases, and with that kind of increased cost of capital, what we've seen in the multifamily sector, it's the better performing markets that are seeing more of a yield reset, so to speak. So, Denver and Atlanta were ranked 2 and 3 last quarter. They're both performing You can see here on the right-hand side, those blue bars, comparatively well improving their attraction from a cash flow standpoint. So it's that kind of movement out in the yields more so on those markets, taking a little bit of heat out of them, that's dropped them down the order. Dallas also, I've just kind of singled out there, another market of choice since the onset of the pandemic, has also seen some of the larger yield increases, but it actually remains at the top end of the order because of the even stronger uptick in the cash flow perspective, as was the case at the top of the order there for Miami, leading the way in terms of the improvement in those forward projected cash flows. And there's a general correlation there in the movement in those cash flows with the trend in market rents kind of dropping down as you get lower down the order and pretty small in terms of those kind of gateway markets, San Francisco, Chicago, and New York. I did call out Boston on the prior slide in terms of stepping up the order, and what sets Boston apart this last quarter is it's one of the few markets where yields continue to contract during the second quarter of the year. So that's the latest quarter. If you track things back over the full 3 years, the first point to note is that positive yield effect across the board. So yields have come down in all markets, but most of the hierarchy in terms of the appreciation on the left-hand side has been played out in that cash flow metric, where it's kind of case of the haves versus the have-nots, with rents for gateway markets seeing minimal uplift in terms of market and contract rent, and actually those contract rents for San Francisco and Houston actually net down over a 3-year time period. The cash flows for then those bottom markets are then held back when you factor in the increased cost to revenue carry, which is being picked up by this year one operating expense ratio. Part of that for those lower markets is an increase in the rental concessions, while across the board we've seen that wider inflationary story take its toll within that metric. But even with the higher operating expenses that are being incurred across the board and tilting out that operating expense ratio, even at the top here, it's a combination of the stronger rental metrics that have kind of pushed those kind of Sunbelt markets up to the top. Okay, so that's the multifamily. Let's move on to the industrial sector. I've now boarded up those numbers for the industrials. And here there's a familiar feel to the order, as we see in prior quarters, but returns, if you see down below, are down across the board, leading to that overall 5.5% dip in industrial performance over the quarter. But in terms of the order, say similar look, familiar look. So Southern California markets are leading the charge, despite even when you're looking at Inland Empire, 6.4% drop in returns, it's still very much up there in terms of the leading sector. And also worth just picking out New York there, which is holding its own, I guess, a pivotal strategic logistics location. You get into the detail of the appreciation, part of that return, so then bifurcating again into yield versus cash flow. Those yield increases that we talked about at the sector level moving out, and we've seen that widening here across most markets. But as with the apartments, it's the better performing markets, the New Yorks, the LAs, the Riversides, that have been subject to the larger pure pricing offsets. And here, I guess, underwriting metrics had become a little tight. But the flip side of that is that these markets are also generally seeing the larger cash flow gains, which is what has kept those markets at the top end of the order. So New York, LA, and Riverside leading the charge. You can see here under market rents. So market rents for LA and New York up about 10% over the quarter. For Inland Empire, Riverside, as market rents are up by 16%. Contrast that with the lower single-digit increases for market rents for Chicago and Houston at the foot of this chart. The other point to note for the industrials, as well as some of the heat being taken out of the market with those yield increases, what we've also seen is some tapering back of what have been historically some of the highest growth rates that we've seen. So a few of those top end markets where those 10-year growth rates have been reined in that regard. So we're seeing a little bit tapering there in terms of both the pricing and some of those kind of cash flow assumptions as well in the last quarter, but nothing that disrupts the overall rank order. If you look at things on a 3-year basis for the industrial sector, strong appreciation across the board, positive pricing adjustments. It's those top end markets that are being separated really in terms of the market rental gains that they've achieved, and Riverside up there pretty much in a league of its own in that respect. But it's not a one size fits all, and this is where we've actually thrown a bit more analysis in there this quarter, because when we've talked through the portfolios in prior quarters, we've noticed a variant coming through in terms of lease terms, so which prompts us to run a little bit more extra analysis. So this is actually just run on the Q1 data. We will try and update this for Q2 as well, but we thought it was worth sharing. So every dot here is a property. Some of those larger appreciation numbers, which is on the vertical axis there, y-axis, are development properties, so maybe kind of discount those. And we're showing the relationship between appreciation and lease length. And what it shows is on some of the longer lease properties, they are achieving slightly more muted levels of appreciation. And one aspect, obviously, that we're picking up here is maybe with those longer lease levels, these assets are less able to capitalize when it comes to Riverside here on some of those record-breaking market rent increases. And we've seen that also. We run this analysis for New York or for LA. So we just thought that'd be worth sharing with everybody. On to offices. Arguably the most complex sector at the moment, and a real mix of fortunes really being played out. Returns, as you can see from the lower table, are pretty much down across the board. The stronger returns in green up top are coming from a mix of some of the Sunbelt type locations. So you've got Miami and Atlanta there ahead of the office average. Also in our other grouping, we're also capturing a number of other Sunbelt markets. I think Austin is a lead performer there. And then on the other greens, you've got the positive impact of medical office buildings and the emergence of life science, which is bolstering the likes of San Diego, also San Francisco, and playing a part there in that stronger Boston return. And then you have the usual suspects at the lower end of the order: Houston's, the Chicago's, the New York's, and the DC's. That continue to remain pretty challenged. Now, NCREIF, I was at the summer conference the other week, and they did announce that later this year they will be updating their property type categorization, so they will be able to separate out life science from MOB. We'll keep in step with that, so we should be able to, by the end of the year, be able to provide a clearer kind of overview of the pure office returns. If you just get into the detail of what we have here for now, for the Q2, we're looking at the appreciation variant, and there's a real divide in the markets between those on the rise, green, and those where values are in decline in the red. And part of that variant is down to those yield adjustments, especially down the lower end of the order, where yields have been increasing. And this is increasing. This is unlike, I guess, the apartment and the industrial sector. So here it's more the challenged markets, I guess, that are seeing the larger yield offset. So pricing more strategic concerns into those markets, as opposed to where we looked at things on the apartment and the industrial sector, where those yield increases were taking the steam out of some of the better markets. Added to which, from a cash flow standpoint, those markets down the lower end of the order face some of the larger headwinds in terms of occupancy levels down. You can see that there for New York. Cutbacks in terms of those actual face market rents versus improvements up top, and also the markets down below seem to be hit with that more operating cost to revenue carry. If you look at things then on a 3-year basis for the office market, there's definitely a split there in terms of the yield and the cash flow on both sides. So the markets at the top have seen some positive pricing adjustments. The markets below have seen those yields move out. You've got gains in cash flow at the top versus contractions down below. And then I've singled out a number of the kind of headwind metrics, and it's the markets down below that's seen the bigger hits to occupancy, larger cutbacks to market rents, seeing more of that kind of cost to revenue carry, and projecting some of the larger capital expense budgets, which is keeping their appreciation levels negative over a 3-year time period. But it's not a one size fits all, and same as the industrial market, there's clearly some form of correlation there with lease lengths. So we've run a bit of analysis there for the office as well. So picking out San Francisco, looking at lease lengths on the x-axis versus appreciation levels on the y-axis. And what we're seeing is it's generally the shorter leases and where there's more roll, where the assets are more subject to, I guess, any declining market forces. The longer lease assets, as you get to the right-hand side, I guess then being afforded a degree of protection by those longer lease positions. So, and we see that for a number of those gateway markets. We just thought that'd be worth sharing with everybody. This is Q1. We will update that for Q2. Changing tact and just getting into the retail sector, which we look at slightly different perspective. We look at this in terms of subtypes, and here it's the larger centres, the malls that have seen the additional risk being priced in. You can see that negative cash and that negative pricing effect for those malls. Cash flows continuing to recover across the board, less so for the malls, and those gains are coming in the form of improved occupancy and those market rents being adjusted back up. That's for 1 quarter. If you do scale the analysis back over a full 3 years, though, there's still ground to be recovered in each of those metrics there, and it's it's the markets down below that have seen the big hits in occupancies, the larger reductions in those malls in terms of growth rates, and the larger kind of cost to revenue carry. Whereas it's the neighbourhood, the power and the community centres that prove themselves to be a little bit more resilient, and both from both a yield and a cash flow perspective. We do break the other sectors down into subtypes as well. So looking at more localized trends here for the office market, just for the last quarter, those downtown markets are still at the lower end. These percentages, just to qualify, are the weights that they account for within the overall, not their returns. The bars show the returns levels versus the overall ODCE average. So those downtown markets are still at the lower end of the order, and high rise are still trending below garden assets within the multi-family sector. That's for the 1 quarter. You see similar variances playing out there over the 3 years as well. And in that other sector, self-storage for the quarter leading the way, hotels coming back, but obviously hotels, very small portion of the overall ODCE, still net down, and storage and healthcare kind of level set with one another. Storage a little bit stronger on a 3-year perspective. Okay, so that was the full extent of what we covered on our webinar last week. So hopefully for those that weren't able to tune in, that's a helpful recap. And for those that wanted just to run through it again, please do send through any questions that you may have. There's the summary takeaway points. We did finish off with a couple of polling questions. One was to ask the audience what they expected the returns to be for Q3. The larger share came out between 1% and 2%. Remember, it was 3.7% return in Q2. So the majority of the delegates came through suggesting 1% to 2%. So continuing the downward trajectory, but appreciation is still positive when you're looking at a kind of around about 1% income return. So only 14% of people stating that they think values overall will be net down in Q3. And there's a couple of percent there expecting things to tick up again. So they may be sector-specific portfolios doing that from a mindset. The other question that we asked, and there's some Q&A, we will send a narrative round on any questions that came through. We also kind of finished off by asking kind of the people that dialed in if they would like to see this type of analysis run on their portfolio from a comparative basis, and there's a large chunk that would like to see that, a fair amount already receiving it. So if anybody does want to see this analysis run on their portfolio, please do get in contact with your contacts at ODCE. So let me just go back to my screen, stop sharing, and thank everyone again for dialing in and running through, helping me run through that analysis with you. As I say, this is a precursor to a lot of the one-to-one client discussions that we have in the coming weeks, and we very much look forward to engaging with our clients, discussing their individual portfolios in the context of those market trends. But thanks very much for your attention today, and we look forward to picking up with you again in 3 months' time. Thanks very much.